your Credit Matters segment today, being brought to you by RSRDebtFree.com, RSRDebtFree.com. Do you have bills that exceed 60 days worth of payment? Means you can't pay them off in the next 60 days. Credit card debt, buy now, pay later debt, private student loans. Maybe you got a car foreclosures that we're seeing a lot of that now again. Have any of these things going on? Well, if you do, RSRDebtFree.com. Fill out the form. We'll reach out to you, and we'll either look at, does a debt consolidation loan work for you? Have equity in your property. That's how we do that one. Or maybe you need to talk to our friend Chris Corrales, and they can negotiate for you on your behalf and maybe help you out in negotiating down some of those balances to make them a little bit more doable. Understanding accounts that may affect your credit utilization ratio is the subject. Your revolving credit utilization ratio is part of the amounts owed category, which can affect about 30% of a typical person's FICO scores. This makes it a potentially significant factor, and FICO score considers your overall utilization rate and the highest utilization rates on specific revolving credit accounts. Here's a primer on which accounts are part of the calculations, which balances matter, and whether carrying a balance on a credit card could help your FICO score so that you can make better informed decisions about managing your credit. Credit cards affect utilization. Credit cards are the most commonly used revolving credit accounts. You can borrow money by using your credit card, pay less than the full balance, and revolve the remainder to your next billing cycle. FICO scores consider credit cards accounts that are in your credit report when calculating your credit utilization ratios. This could include accounts that you open on your own and accounts that you're an authorized user on. What about charge cards? Charge cards often look like credit cards, and you might be able to use them to make purchases online and in stores. However, charge cards are open lines of credit, not credit cards, which are revolving credit accounts. With a charge card, you can borrow money, pay off the loan, and borrow money again without applying for a new account. But you often have to pay off the entire balance each month. You can't revolve a portion of the balance with a charge card. Generally, if the card issuer reports the charge card as an open credit account, it will not be included in the revolving credit utilization calculations. What about debit cards? Debit cards don't affect your credit utilization because they aren't revolving credit accounts and they are not reported to the credit reporting agencies. You're not borrowing money when you make a purchase with your debit card unless you overdraw your account. However, some companies offer bank accounts with an accompanying card for building credit. These cards function like debit cards, allowing you to make purchases and have the amount immediately withdrawn from your account to cover the balance. But they might actually be secured credit cards. If the company reports the card as a secured card to the credit bureaus, it could affect your credit utilization ratio. Number 2, personal lines of credit affect utilization. An unsecured personal line of credit is another type of revolving credit account. Similar to a credit card, you may receive a maximum credit limit, can take out loans against a credit line, and repay the balance over time, sometimes making interest only or minimum monthly payments. Alternatively, the line of credit may have an initial draw period when you can take out loans. The draw period is followed by a repayment period when you have to repay the outstanding balance on a fixed schedule. As a type of revolving credit account, your personal lines of credit could affect your credit utilization rate. What about a home equity line of credit? A home equity line of credit, HELOC, is similar to a personal line of credit, except you use your home as collateral to secure the line of credit. FICO scores treat HELOCs different than unsecured personal lines of credit. The HELOC is still considered a revolving credit account in terms of your credit mix. Your payment history amount owed and the account's age can also affect your FICO scores. However, the FICO score generally excludes HELOCs from credit utilization calculations. Closed revolving accounts with balances affect utilization. Sometimes card issuers will close past due credit cards. You also might choose to close an account and then pay off the balance over time. FICO scores would consider these closed revolving accounts with a balance in utilization calculations. Once the current balance is reported as zero, the closed account will no longer be included in your credit utilization. This is why closing a paid off credit card might increase your utilization rate. The available credit on the card will no longer be included in your total available credit. Keep in mind, knowing which accounts the FICO score considers when calculating credit utilization is important. Additionally, you may want to consider the following tips. FICO scores use the credit limits and balances from your credit report to calculate utilization, which may be different from the current balances that you see when you're checking account. A low utilization rate might be better for your FICO score than a zero utilization rate. Keep it down just below 10% is where the best numbers are going to be. Just below 10%. You don't have to carry a balance to have credit utilization because card issuers generally report your account information before your bill is due. That's why we tell you at rsrccpayment.com, rsrccpayment.com, pay the bill right before the statement closing date. Leave a balance on there because you're going to pay that with the automatically set up payment that's at the payment due date. Some people recommend keeping individual account and overall utilization rates under 30%, but the 30% point doesn't determine who has good or bad credit. A lower utilization rate could be even better. For example, people with 850 FICO scores have an average overall utilization rate about 4.1%. So like I said, stay under 10. Most FICO scores only calculate and consider utilization rates based on the most recently reported account information. However, FICO Score 10T considers trends in your credit history, which may include trends related to your utilization. Just had an interesting one recently that I saw, and I will share it with you. This is why I do this intentionally. So I paid off an auto balance. One of my cars just paid off, and my FICO score dropped 19 points. 19 points by paying off the car. Why? Because it's an installment loan. That affects the credit mix. So because that installment loan is now paid off, my score actually dropped again by 19 points. So not a whole lot you can do about it. I mean, the loan is due. You pay it on time. That's just the way it works. That is Your Credit Matters, brought to you by rsrdebtfree.com. rsrdebtfree.com. Again, if you've got debts that are more than 60 days out, let's talk about it. Let's see how we can get you out of those debts. Part of our Repay Smart process.